welcome. You're watching Managing Money with Moneycontrol. I'm Sakshi Batra. Can you believe it? Another year has rolled on, and what a year it has been. Ending with markets at all-time highs, yet the economy at multi-quarter lows. And so many headlines in between. Well, the year 2019 has also been about many learnings in terms of our money and our personal finance. And the question now is how to ensure that 2020 is a profitable year for you. Let's discuss this with our personal finance expert for the day, Mr. Amol Joshi, founder of PlanRupee Investment Services. Thanks a lot for joining in yet again, Amol. Let me begin by asking you, what are your thoughts about 2019, the year gone by, and what are the big learnings one must really pick up in terms of personal finance from 2019?
Right. So there are a couple of learnings on personal finance front. I would go to the biggest one in debt funds. As you know, debt funds AUMs have picked up quite a lot, especially after the FD rates comparatively have fallen. In debt funds, most of the people who shifted without understanding the impact of what exactly credit risk fund is all about or what exactly are AAA funds about, those people faced a lot of hardships in credit funds. Now you should, as a learning, you should remember, if you are a completely conservative investor who wants a FD equivalent sort of a returns experience, then you are probably best served with AAA rated mutual funds, commonly known as corporate bond funds or even PSU bond funds, banking and PSU debt funds. On the other hand, if you are somebody who can take risk and remain invested for a length of time, especially 3 years or more, only then credit funds make sense to you. That's number one. Number two, on equity side, you had pretty narrow sort of a rally. Indices are close to all-time high, but as the press commentary tells us, only a handful of stocks have gone up. This is a good reminder for investors that equity is a long-term asset class. Other than those 10, 12, 15 stocks, if you are not really made money, stay invested for a longer period of time. When the rally will acquire more a broad-based sort of a nature, and then obviously you will make up for the lost returns. Follow the asset allocation. These are some of the lessons from 2019.
Right, Amol. Now, also for people who invest in stocks or maybe mid caps and small caps, the big dichotomy was that even though the Sensex and the Nifty ended 12 to 14% higher, the green on the frontline indices is actually not reflecting in their portfolios. So what are they really worried about is that perhaps what will happen to their funds in 2020? Will they perform, or should they really switch to large caps?
Sakshi, here I would like to answer the second part of your question first. Should I switch to large cap now? I would say that large caps have had a fair run up over last 1.5 years, and I wouldn't really call them that they are trading at cheap valuations. The idea of the simplest fundamental point of investing in equity is always buy low, sell high. Currently in mid and small caps, you probably have lower valuation, thereby fulfilling first half of the mantra, buy low. So I wouldn't advise buying into large caps, number one. Number two, what should a typical portfolio look like in 2020? I would say that go back to basics, go back to your asset allocation. Within equity also, you can have asset allocation of how much component of my money goes into large caps and how much component goes into mid and small caps. So I would say, given the nature of how the markets currently are at, I would say about 40 to 50% portfolio to large caps and about 50 to 60% portfolio can remain in mid and small caps to benefit from mid and small cap rally or broad based market rally as and when it happens.
Right. Now, also from an asset allocation point of view, Amol, if you could tell us, will 2020 be a good year in terms of equities? Will it be volatile, or will the bulls really tide over?
I would say that the reason behind markets not doing well, especially the broader market, GDP growth not being very market friendly, I would say there are views coming up that we are probably turning a corner. Lots of PSU banks are back into profitability. GDP, because of lower base, is likely to show up better numbers going into the new year. I would say that equity outlook fairly remains decent to good. Markets are likely to do well. But having said that, when I say this, always remember equity is never a 6-month, 3-month or a 1-year asset class. Equity is always a long-term asset class. If you have a 3-year, 5-year, 10-year sort of an investment horizon, this is a good time to invest in equity, especially in segments other than mega caps.
Also, Amol, which according to you are the top 5 mutual funds to look out for in 2020?
So let me say something, if you are a completely conservative investor who wants to have a better post-tax returns and graduating from fixed deposits into mutual funds, you are probably better served with a AAA rated corporate bond funds. So that's first segment where investors can look to deploy their money. If you have a 3 to 5 year sort of an investment horizon, I would say that you can go to equity hybrid funds, or even better, dynamic asset allocation funds, or popularly known as balanced advantage funds. That's the second category that you can look at for that typical investment horizon, 3 to 5 years. Now, the third point that I'm going to make is not necessarily a product, it's a tool. If you are somebody who has a monthly cash inflow, typically a salaried investor, and after monthly expenses, you are left with some kind of monthly surplus. So I would say that if you have yet not joined the SIP bandwagon, please invest your monthly surplus via SIPs. So it's a tool, not necessarily product. I am clarifying it again. Number 4, if you really have a 10-year plus horizon, meaning if you are planning for your child's education or your own retirement corpus 10-20 years down the line, 10-15 years down the line, you can probably take exposure to mid and small caps. That's number 4. And number 5, this is probably at the very beginning of a mutual fund investment journey. If you want a product that will come in handy for your emergency needs, then you can probably look at liquid or overnight funds. Most investors maintain their comfort money or emergency sort of a money in their savings account. Saving account, as we know, most commonly generates about 3 to 3.5% return. Liquid funds or overnight funds are likely to generate a better return, and especially on a post-tax basis. So I think these are my 5 picks. These 5 picks or product specific products serve different needs of variety of investors.
Right. Now, we also need to talk about fixed income assets. Just barely had people really begun thinking beyond fixed deposits. And we saw INFS and also DHFL kind of crisis, which jolted the investors really. So if not by the AAA ratings or rating agencies, how should people really decide on investments into the debt funds, especially if they just need to invest for a short term, that is 1 to 3 years?
Right. So Sakshi, having 1 or 2 AAA default is actually not, it doesn't signify that other 99% of AAAs will also default. AAA remains a very good investment avenue as far as risk adjusted returns are concerned. So I would say again, I would repeat again, that if you are somebody who wants a fixed deposit sort of an investment experience, but with better post-tax returns, because mutual funds, as we know, debt mutual funds, if you stay invested for more than 3 years, you get a wonderful tax benefit called as indexation benefit. I would still say that AAA still remains a good choice for all the investors.
Will 2020 be a good year for real estate and gold? And should people really go ahead and get that home or add that gold in their portfolio in 2020?
I would say buying a home or a flat or a residential property is one of the most important and one of the biggest financial decisions. If you have accumulated enough money to put it as a down payment, almost all the banks or financial institutions ask you to put down about 20-25% of the amount upfront. If you have accumulated that sort of an amount, and if you are really looking to buy a house, if you are really looking to buy a flat for your own consumption, then this could probably be a good time. Not just because the real estate rates, property rates are not really at all times high, also because recently SBI has announced that their home loan rates have gone down by about 20 to 25 basis points. Considering this point, this could be a good time, but there is a very big star mark over here. Please go and buy only if it is your property for your consumption needs. Property as an investment, the rental yields are still below 2-2.5%. That really doesn't make sense. Second part is gold. Gold, traditionally speaking, everybody, all the experts will advise you that gold or precious metals should form about 5 to 10% of your portfolio. Now, this is irrespective of the cycle. No matter if you are entering 2020 or this advice is as good 5 years back and it will remain good for time to come. You can have a gold as a financial investment at about 5 to 10% of your portfolio. Gold is hedge against inflation, and this kind of exposure is good enough.
Well, thanks a lot, Amol, for sharing these insights on the learnings from the year 2019 and an outlook for the year 2020. With that, it's a wrap. Do write into us at moneycontrolpf@nw18.com with your feedback and comments. Many thanks for watching and wish you a very happy new year.